Hello and welcome to this wonderful chapter, Advanced Capital Budgeting. Today we are going to take very important questions on sensitivity analysis taken from study material, past exam, RTP, MTP and reference books also. Okay, so pay attention and solve all the questions in the notebook. So we will start with question number 36, 6 to the power 2, 6 square. Question number 36. The similar question was asked in November 2009 exam for 8 marks. So question is like this. On the screen, the following forecasts are made about a proposal which is being evaluated by a firm. Initial outlay is 12,000, cash inflow 4,500 per annum, life of the project is 4 years, cost of equity 14%, that we will use as discount rate. Then you are given PV annuity factor 14% 4-year annuity factor, 14% 3-year annuity factor is given. Whichever you require, you are going to apply that. And then analyze the sensitivity of different variable with respect to NPV. So I am going to ask you a question. What are the different variables in this question which will affect the NPV? Please name 4 variables which will affect NPV. 4 variables. Come on student. 4 variables which will affect NPV. 4 variables which will affect NPV. Cash flow. Okay, which cash flow? You are talking about cash inflow. Live. Very good. Live. Very good. One student is replying cash inflow live. And cost of the project also. And discount rate also. All these 4 factors are going to affect NPV. Sensitivity of different variable means what can be the cost of the project at which NPV will be equal to 0. That means we need to find out to what extent the cost can rise and NPV will be 0, not negative. In case of cash inflow, to what extent cash inflow can decrease such that NP will be 0. In case of life, what is the minimum number of years the project should run so that my initial investment is recovered. And same thing for cost of capital also, discount rate, to what extent the discount rate may be allowed to rise such that NPV becomes 0. So my target NPV in all these 4 cases would be NPV should be 0. What should be the value of this variable? What should be the value of this variable at which NPV will be equal to 0? That is how we are going to do the sensitivity analysis for that. But first thing first, let us check what is the NPV of the original project. Please write down. Please write down calculation of NPV of original project. Calculation of NPV of original project. Calculation of NPV of original project. Under that write down 4 columns: year, cash flow, discounting factor at 14%, discounted cash flow. You can write present value also here. You can write present value also here. So let us solve this very easy question. But this is an exam question, trust me. In year 0, 12,000 outflow, cost of the project. year 1-4, 4,500 cash inflow. Factor is given in the question. 14% 4-year factor is given in the question. So please use it from the question book only. Use it from question book 2.9137. Multiply please. 13,112. Therefore, NPV is 1,112. Very good, Pathan. NPV is 1112 is right. If NPV is positive, then only I will apply sensitivity analysis. If NPV is already negative, then I can't apply sensitivity analysis. Any further adverse movement in the variable will reduce the NPV further. So first thing is that the original project should have positive NPV. The original project should have positive NPV. The original project should have positive NPV, otherwise there is no point in applying sensitivity analysis. Now there are 4 variables, we are going to test one by one. First write down sensitivity analysis with respect to initial outlay. Sensitivity analysis with respect to initial outlay. That means question is, my cost of the project is 12,000. If it goes up, my NPV will reduce. To what extent it can go up such that my NPV is 0? To what extent we can allow it to go up so that NPV is 0? So the answer is 1,112. Even if the cost of the project, I'll go to the previous slide, even if the cost of the project suppose rises to 13,112, you don't have to do anything, you have to just observe. If this goes to 13,112, my NP will become 0. So my margin of safety is 1,112. Even if cost rises by 1,112, I am still okay with that. My NPV will not become negative. Write down a note first. Write down a note, the maximum amount by which the initial outlay can increase. The maximum amount by which the initial outlay can increase without making NPV negative, is rupees 1112, is rupees 1112. Therefore margin of safety is 1,112. Your NPV is your margin of safety. To the extent you have positive NPV, that is your margin of safety. Therefore sensitivity percentage equal to margin of safety upon initial outlay. Margin of safety 1112 divided by 12,000 into 100. Anybody who would like to reply? Any volunteer who would like to reply? What is the answer for this? One student has replied. Very good. Some of you are good student. So the answer is 9.27%. 9.27%. How do you interpret 9.27%? If the cost of the project rises by 9.27%, NPV will be 0. NPV will be 0. So you have a margin of safety of 9.27%, as far as initial outlay is concerned. Let us try the next one. Next line, write down sensitivity analysis with respect to cash inflow. Sensitivity analysis with respect to cash inflow. For that, I need to find out what is the minimum annual cash inflow required. My cost of the project is 12,000. Understand, cost of the project is 12,000. PV of cash inflow should be 12,000. If PV of cash inflow is 12,000 and cost of project is 12,000, my NPV will be 0. So to get the PV of cash inflow 12,000, how much should be the annual cash inflow? How much should be the annual cash inflow? The annual cash inflow will be 12,000 divided by annuity factor for 14% and 5 year. Then only your present value of cash inflow will be 12,000 and your NPV will be 0. So 12,000 divided by, factor is given in the problem, 2.9137, so 4118. Your annual cash inflow should be at least 4118 so that the NPV is 0 or positive, not negative. Is it right? And what is my original estimated cash inflow? 4,500. Do we have margin of safety here? Do we have margin of safety here? Say yes or no. Yes. How much is the margin of safety? Even if my cash inflow goes down to this number, we will still have positive NPV or 0 NPV. So I have a margin of safety of 382 rupees. So right now write down sensitivity percentage. Sensitivity percentage will be margin of safety divided by annual cash flow. Margin of safety divided by annual cash flow. Margin of safety 382 divided by annual cash flow 4,500. Change upon base. Change 382 base 4500 into 100. Therefore, the answer is 8.49%. Is it right? Just confirm, is it right? 8.49%. 8.49% is right. Very good. Now the next calculation is, wait a minute. This question can be answered alternatively also. Write down alternatively. I am going to give you one more way to solve cash inflow sensitivity. Write alternatively. Directly we will write sensitivity percentage equal to NPV upon PV of cash inflow. NPV is my margin of safety, remember, because to the extent we have positive NPV in the original question, to that extent I have margin of safety. I can let it go down. What was NPV in the original question? NPV was 1112 and PV of cash inflow was 13,112. This was my PV of cash inflow in the original question. Sorry, this was my PV of cash inflow in the original question. This was my NPV. So proportionately what amount you can allow to fall, what percentage can be reduced so that the NPV will become 0 is 1112 divided by 13112. Both are in present value terms, so they are comparable also. Multiply by 100, give me the answer now. What is the answer now? Is it same answer, 8.48 or 8.49? Yes. So please write down. This is a shortcut. Suppose you don't have time in the exam, you can simply compare NPV and PV of cash inflow, because this number, if falls by this number NPV, your NPV will become 0. So percentage drop required is 8.49%. Now I'll go to third point, sensitivity analysis with respect to life of the project. Life of the project means we have estimated 4 years, but suppose the project life is actually lower than this, your NPV will reduce. If project actually runs for less than 4 years, NPV would be lower. So to what extent we can allow the life of the project to get reduced and still I'll be able to recover my initial investment. So for that I need to compute what is called, in your capital budgeting chapter you have studied discounted payback period. What is discounted payback period? Time required to recover your initial investment. At least the project should run for a period equal to discounted payback period so that your initial investment is recovered. Okay. Whenever they will ask you sensitivity with respect to life of the project, you need to compute discounted payback period. For life of the project, compute discounted payback period. I hope you have studied discounted payback period. If not, we'll do it today. Don't worry, write down sensitivity analysis with respect to life of the project. Then write down below calculation of discounted payback period. Calculation of discounted payback period. 5 columns we will draw. First column year, second cash flow, third column discounting factor at 14%, fourth column discounted cash flow, or you can write present value, last column cumulative discounted cash flow or cumulative PV, or cumulative PV you can write. I hope now you are able to recollect something like this you have studied. Year 1, 2, 3, 4. Year 1, 2, 3, 4. Cash flows are 4500 in all the years. 4500 in all the years. Take your calculator. Discounting factor will be 1 upon 1.14 equal to, keep writing the factors, equal to. This time I can't apply 1-4 because then we'll not get to know what is the discounted payback period. For discounted payback period we have to write separately for each year. Now please multiply. I will tell you one shortcut. Number to be multiplied is common. So first time you will take 4500 into 0.8772 equal to. Next time you just type this number, press equal to, and you will get the answer. Type this number, press equal to, you will get this answer. Type this number, press equal to, you will get this answer. So sometime we have to know how to use calculator fast. Cumulative DCF 3947 plus this number, add these two number 7410, add this number 10,448, add this number 13112. Discounted payback period means time required to recover initial investment. Initial investment is 12,000 rupees. Initial investment is 12,000. In 3 years, we have recovered 10,448. And in 4th year, we have recovered 13,112. which means my discounted payback period is between 3 and 4 years, more than 3 but less than 4. To calculate the exact discounted payback period, you will write 3 year, because in 3 year we have recovered 10,448 and I need to recover 12,000 minus 10,448. This amount I need to recover. I need to recover this amount more, divide by, but in the fourth year my total amount recovered, total amount received is 2644. So I'll divide by 2644. That will give me proportionate time period required in the fourth year to recover the balance amount. Kindly solve and give me the answer. Anybody answer 3 year something? So can I say 3.58 years? 3.58 years. 3.58 years is right. 3.58 years. Now original budget was 4 years, but you need minimum 3.58 years to recover your initial investment. Therefore write down margin of safety. Margin of safety 4 minus 3.58 is equal to 0.42 year, and therefore sensitivity percentage will be 0.42 divided by original estimated period 4. 0.42 divided by 4. Yes, answer please. 0.42 divided by 4 into 100. 10.5%. Very good. Is it 10.5%? Yes. So this is called sensitivity with respect to life of the project. Now we'll go to sensitivity analysis with respect to cost of capital. There are 4 variables, 3 we have done. Now this is the 4th one. Sensitivity analysis with respect to cost of capital. What should I compute? You have to answer. What should we compute? Sensitivity analysis with respect to cost of capital means to what extent cost of capital can rise such that NPV will be 0. What is that discount rate at which NPV will be 0? I am giving you a hint. What is the discount rate at which NPV will be 0? So what do you call it? You call it IRR. Very good answer. You call it IRR. So basically, whenever they will ask you to apply sensitivity testing to cost of capital, you need to calculate IRR. At IRR, all of you have studied NPV is equal to 0. So I need to compute IRR. You are right. Rajesh is also right. IRR you have to compute. Very good, Rajesh. Now we'll come to calculation of IRR. IRR. Write down sensitivity analysis with respect to cost of capital. Under that write computation of IRR. Then you draw this format for IRR calculation. Draw this format for IRR calculation: year, particular, cash flow, discounting factor, at the rate of. I will ask you the discount rate later. What will be your starting rate? What will be your starting rate? I will ask you. Then I will have one more discounting factor at the rate of, but I will ask you later. Under that 2 columns each, discounting factor and discounted cash flow. Discounting factor and discounted cash flow. Write down year 0 cost of the project 12,000, year 1 to 4 annual cash inflow, year 1 to 4 annual cash inflow 4,500, annual cash inflow 4,500. So what should be my start rate? All of you please take on your calculator 12,000 divided by 4,500. I need an annuity factor. I need an annuity factor of 12,000 divided by 4,500 is equal to how much? 2.6667 or something. Is it right? 2.6667. If I have an annuity factor of this number, my PV of cash inflow will be equal to 12,000 and NPV will become equal to 0. Now what you have to do, at the end of the book, this is our book, okay, those who have the book, you go to end of the book, there is a present value table, present value annuity table, present value annuity table. Can you locate PV annuity table? A table B, table B. At the end of our book we have a table B, and in the table B, page 16.5, go to fourth year. Go to fourth year. First column is year 1, 2, 3, 4. Move towards the right and search for 2.6667. If it is not on that page, go to the next page. Second page you will find. Second page you will find it is 18%. At 18% it is 2.6901. At 18% can you locate 2.6901, and at 19% you will find it is 2.6386, which means this number is somewhere between the two. Hence I will start with 18% and I will take second rate as 19%. Is it right? So in case if you have annuity table with you, then in that case you can, if you have annuity table with you, then in that case you can decide the start rate and end rate very easily. Okay, ready? Year 1, write down year 1 12,000, 1-4. You can take the factor from that annuity table, 2.6901, multiply please, it is 12,105, NPV is 105, positive NP means increase the rate. So take the rate 19% now, 19%, factor is from the book, you can copy from there, 2.6386, very good, come on, multiply. Multiply 4,500 into 2.6386, you will get this answer, and therefore NPV is negative. Therefore NPV is negative. Now my dear students, I am not going to solve IRR for you. We have done it several times in the current batch also. Find out IRR yourself. Please find out IRR on your own and reply. If you don't reply, I'll keep waiting. Yes, reply please. How much is IRR? It is more than 18, less than 19. 18 point something you will get. 18 point something. So you will write like this: 18 plus in bracket 105 NPV at lower discount rate upon difference between NPV at lower discount rate and NPV at higher discount rate into difference between the two discount rates 19 and 18. Anybody answer please? Nobody is replying. I am little disappointed. It seems it is my exam, not your exam. You are not even able to reply IRR and you are dreaming of becoming CA. Really amazing. Is the answer 18.45%? Is the answer 18.45%? Now write down margin of safety. Your original expected discount rate is 14, but discount rate can rise. To what extent it can rise and still my NPV will not be negative? It can rise up to 18.45%. Is it right? So my margin of safety is 4.45. Then write down sensitivity percentage. Sensitivity percentage equal to, take 4.45 divide by original estimated rate 14. Answer is 13.79. 13.79 is the margin of safety. So this is how you will apply sensitivity testing for 4 variables. Whenever they ask life of the project, discounted payback period. Whenever they ask cost of capital or discount rate, you will compute IRR. Okay. Whenever they ask cost of the project, initial investment, NPV divided by initial investment. NPV is my margin of safety and hence NPV can be used wherever required for computing sensitivity percentage. Now we'll go to question number 37. Write down very, very important question. It is from RTP. The size of the question is 1 full page. Can you see that size of the question? It's a good question. Okay, not in the current study material, but in the old institute's RTP. Question is like this. AS Limited is considering whether to set up a division in order to manufacture a new product, the Agni. So name of the product is Agni. The following statement has been prepared showing the projected profitability per unit of the new product. So this cost accountant has done this calculation. Selling price is 22, material cost is 3 kg at the rate 1.50 per kg, which is 4.50. Labor 2 hours required at rupees 2.50 per hour is 5, and all overheads put together is 11.50. Total of the cost is 21 and therefore profit per unit is 1 rupee. This is what they have done. Is it understandable? A feasibility study. Feasibility study means the company wants to see whether this project will be accepted by the market or not. Recently undertaken at a cost of 50,000. Recently undertaken at a cost of rupees 50,000. Undertaken means already spent, already incurred. Already incurred means past cost. Past cost means sunk cost. Sunk cost means irrelevant in decision making. irrelevant in decision making. Sunk costs are irrelevant in decision making. So this 50,000 rupees will not be included in my answer. It is already incurred before taking the decision. If you have already incurred expense before taking the decision, it is called sunk cost and it is not relevant in decision making. So let us read the statement again. A feasibility study recently undertaken at a cost of 50,000 suggested that a selling price of 22 rupees per unit should be set, and that is how this 22 has come here. At this price, it is expected that 10,000 unit will be sold each year. Quantity to be sold is 10,000. Underline, I will require this for calculation purpose. Demand for the product is expected to cease after 5 years. The life of the asset is 5 years. Direct labor and direct material costs will be incurred only for the duration of the product life. Direct labor, direct material are variable cost. The meaning of this line is that they are variable cost. If they are variable cost, they will be incurred only if there is a sale. If there is no sale, they will not incur material labor cost. And what about the overheads? You see, overhead is given here in the first table, overhead 11.50. They have given you the breakup of that overhead per unit. It includes variable overhead 2.50, rent per unit. This is all per unit. They have divided by 10,000 unit, and there is a note A below. Manager salary 0.70, note B below. Depreciation, note C below. Head office cost, note D below. And this is how 11.50 was calculated. Now we have to read note number A for rent, note number B for salary, note number C for depreciation, note D for head office cost. And if you can read it carefully, interpret it carefully, then you will be able to crack this amazing question. Note number A says Agni would be manufactured in a factory rented specially for the purpose. This factory was rented for manufacturing of Agni. Rental would be 8,000 payable as long as the factory was occupied. As long as factory was occupied. So it's a fixed overhead. But my question is, option A, is it relevant? And option B, is it irrelevant in decision making? You just have to tell me relevant or irrelevant, R or I, relevant or irrelevant, relevant or irrelevant. Please reply fast. We are running short of time. It is relevant because you are going to incur rent only if you manufacture Agni. So it is incremental overhead. It is incremental fixed overhead. Incremental fixed overhead, relevant. Point number B. Point number B. You have to reply fast. Okay, keep your typing ready. Okay, the chat box where you type should be ready. It is an interactive class. It's not for me. If you want pre-recorded lecture, I already have it. A manager would be employed to supervise production of Agni at a salary of 7,000 per annum. The manager is at present employed by the company, but he is due to retire in the near future on an annual pension of 2,000. If he continued to be employed, his pension would not be paid during the period of employment. His subsequent pension right would not be affected. My question is, first, is it relevant or irrelevant? Second question, if relevant, how much amount is relevant? First question is whether relevant or irrelevant. And if you say it is relevant, how much amount is relevant? 7,000 is relevant, 2,000 is relevant, or 5,000 is relevant? So the answer is it is relevant and 5,000 is relevant. We have to pay him 7,000 rupees for supervising production of Agni. But if we don't employ him, then we are going to pay him 2,000. So by employing the manager, my incremental overhead will be 5,000, not 7,000. My incremental overhead will be 5,000. If he is not employed, you have to pay him annual pension of 2,000. So what is your additional burden of employing the manager? By employing the manager, you have to shell out additional 5,000 from your pocket. 5,000 is relevant. So for the second part, 5,000 is relevant. For the first part, rent 8,000 was fully relevant. 7,000 is not relevant. We have to always use incremental overhead while doing capital budgeting. How much more I have to incur because of my decision? Because of my decision to manufacture Agni, I have to incur 5,000 more. I have to pay him 2,000 in any case. Even if I don't manufacture Agni, I have to pay him 2,000. If I manufacture Agni, I have to pay him 7,000. So my incremental overhead is 5,000. Now next is point number C. Manufacture of Agni would require a specialized machine costing 2,50,000. Underline, this is my initial investment. Relevant? Yes. The machine would be capable of producing Agni for indefinite period. Although due to its specialized nature, it would not have any resale or scrap value when the production of Agni ceased. It is the policy of AS Limited to provide depreciation on all fixed asset on straight line basis. So 2,50,000 divided by 5 years, you get 50,000 depreciation. 2,50,000 divided by 5 years, 50,000 equal to the period during which Agnis are expected to be produced. Again my question is, relevant or irrelevant? Relevant or irrelevant? Depreciation. Come on, quickly. You don't have to think. I am not asking you the formula to develop rocket science. So the student is saying relevant. Wait. If there is taxation, it is relevant. If there is no taxation, it is not relevant. So I need to read the problem till the end, because depreciation is relevant only if there is taxation. It helps you to save tax. No tax, no depreciation required in our discussion. Next point, AS Limited allocates its head office fixed cost. The last was head office fixed cost. Allocates its head office fixed cost to all products at a rate of 1.25 per direct labor hour. At the rate of 1.25 per direct labor hour. Now this line you underline, total head office fixed cost. Total head office fixed cost would not be affected by the introduction of the Agni to the company's range of products. Would not be affected by the introduction of the Agni to the company's range of product. Same old boring question. Is head office cost relevant or irrelevant? Relevant or irrelevant? The answer is irrelevant. Very good answer. Very good answer, because the line very clearly says head office total cost would not be affected by the introduction of Agni. The meaning of this line is that incremental overhead is 0. Incremental overhead is 0. only allocation will change, but no additional cash outflow will take place. Decision making requires you to understand whether your decision will cost you something more. The answer is no here. It's only the allocation over different machines will change, but overall cost will remain the same. So incremental cost is 0. Incremental cost is 0. Depreciation discussion is still pending. Let us read further. The required rate of return of AS Limited for new project is estimated at 5% per annum in real term, and you may assume that all costs and prices given above will remain constant in real term. So cash flow is real, discount rate is real. Real cash flow will be discounted using real discount rate. All cash flow would arise at the end of each year, with the exception of the cost of the machine, which would be payable at the beginning of the year. Till now they have not given tax rate. And now the question number A. Prepare NPV calculation based on the estimates provided to show whether AS Limited should proceed with manufacture of Agni. Whether AS Limited should manufacture Agni. Tax rate is not given. If tax rate is not given, depreciation is irrelevant. If tax rate is not given, I don't need to compute depreciation. Even if I deduct depreciation, I'll add back the same amount. My answer will not be affected. Second part, where are you going? Come back, yes. Prepare a statement showing how sensitive the NPV of manufacturing Agni is to the error of estimation in each of the three factors. So here we have to do sensitivity analysis for three factors. Product life, we will compute discounted payback period. Same. Annual sale volume, what should be the sales quantity at which NP will be 0. Question is, at what will be the sales quantity at which NP will be 0, and then what should be the material cost per unit at which NP will be 0. So some mathematics skill will be required. Okay, you have to do some mathematical calculation and find out what should be the quantity, what should be the material cost, and each item is examined independently. That means we will check one variable at a time, keeping other variable constant. Is it right now? But first answer first. First answer is a simple problem of capital budgeting, where they are asking you whether we should manufacture Agni or not. Whether we should manufacture Agni or not. Write down. Evaluation of the proposal. Evaluation of the proposal to manufacture Agni. Evaluation of the proposal to manufacture Agni. Draw this table. Year, particulars, cash flow, discounting factor at 5% and present value. In this question there is no taxation. If there is no taxation, depreciation is not relevant. Secondly, discounting factor is given in real terms. Cash flows are also given in real terms. So discounting can be done directly by using real discount rate. Real cash flow should be discounted using real discount rate. They could have also given adjustment for inflation also, but they have not done. They are very kind institute. Okay, otherwise this question can have inflation adjustment also. First you write down year 0, cost of the machine 2,50,000. Year 1 to 5, annual cash inflow working note 1. Annual cash inflow working note 1. So I will give you 20 seconds to try and tell me what is annual cash inflow. 20 seconds starts now. Annual cash inflow. Student will reply. If you don't reply, I will not write the answer. Annual cash inflow. Annual cash inflow means sales minus cost, not just sales, because you have to incur the material cost, labor cost, certain overheads also. So 2,20,000 is not right, that is your sales figure. Sales minus expense. Sales minus expense. Please try. Kindly inform your other friends also about these lectures. They will also be benefited. One student is saying 10,000. One student is saying 2,20,000. Probably you are making some serious mistake. When I was explaining, you did not pay full attention. You have to only consider relevant cost in decision making. Is it right? So the answer 10,000 means you have simply multiplied 10,000 into 1. Then what is the point in this whole discussion? You have considered depreciation also. You have considered head office cost also in your discussion. So that is not right. One should think properly, think like a decision maker, not like an accountant. So answering 10,000 is an accountant way of thinking. We are not accountant right now. Right now we are decision maker. So I have to see my inflow will be 2,20,000 and how much will be my outflow because of the decision. So write down working note 1. Mr. Sajid is saying 1,82,000. I think that is also not right. Let me check. Start. Write down working note 1. Calculation of annual cash flow. Don't worry, only with practice you will learn. Practice is very important in this topic. Selling price 22, because this topic will challenge you. It will make you think. Okay. Variable cost per unit, under that we have material 4.50. Presentation can change, I agree. Final output, final answer should be the same. Labor cost is 5, relevant. Variable overhead 2.50. Variable overhead 2.50 is relevant because it will vary only when there is a production. So this is my 3 variable cost, material, labor and variable overhead. Together they are 12 rupees. 22 will be my selling price, 12 rupees my variable cost. So contribution means sales minus variable cost. How much each unit is contributing towards recovery of fixed overhead and towards profit. So that is 10 rupees. Number of units sold 10,000. Number of units sold 10,000, but I need to deduct fixed cost also. Point number E, write down total contribution. Total contribution would be 1 lakh. Total contribution will be 1 lakh. Now out of that 1 lakh we will deduct only relevant fixed cost, only incremental relevant fixed cost. Okay, not all the fixed cost. So under that one is rent, which is incremental rent because it will be paid only if the company manufactures Agni. And second, manager salary, the incremental portion is relevant, 7,000 minus 2,000, and that is 5,000. Depreciation is not relevant, it is a non-cash expense. Relevance of depreciation is if there is tax liability on the company, presence of depreciation will reduce the tax liability, but there is no tax in this question. And head office fixed cost is not relevant because total head office fixed cost will not be affected by the decision. So my total incremental overhead, incremental fixed overhead is 13,000 only. Contribution minus fixed cost, contribution minus fixed cost is 87,000. Sajid Khan is right, 87,000. But after 2 trials you are able to generate that answer, 1 or 2 trial, no problem. Now you have understood. Waiting for any query that you have. Write nicely. Presentation is also important because somebody has to check your paper and he has to understand your answer. Can I go to the main page now? On the main page, write 87,000 here. Calculate the annuity factor at 5%, 5 years. 5% 5 years. That comes to 4.3295. 4.3295. Multiply. Then find out the NPV and just confirm whether this NPV 126,667 is it right? Is it right? Yes. This is my first answer. Okay. If only first question is asked, you will stop here. You will say advise company should manufacture Agni as the NPV is positive. Company should manufacture Agni as the NPV is positive. Company should manufacture Agni as the NPV is positive. Now write down notes. Some notes I will dictate in future. If you have doubt, first read the note. Note number 1. Note number 1, the feasibility study cost. The feasibility study cost in bracket rupees 50,000 being sunk cost is irrelevant in decision making. Sunk cost is irrelevant in decision making. Second note, write down the manager's salary to the extent of rupees 2,000 is irrelevant. Manager's salary to the extent of rupees 2,000 is irrelevant as it will be paid irrespective of the decision. As it will be paid irrespective of the decision. As it will be paid irrespective of the decision. Next point, write down depreciation is irrelevant. Depreciation is irrelevant as it is a non-cash expenditure. As it is a non-cash expenditure and there is no tax in the problem. And there is no tax in the problem. Point number 4. The allocated head office fixed cost. The allocated head office fixed cost is irrelevant. The allocated head office fixed cost is irrelevant as they would not be affected by the decision. as they would not be affected by the decision. As they would not be affected by the decision. So these are the explanation for some points in the problem. If your doubt will be why we have not taken 50,000 feasibility cost, irrelevant. Why we have not taken depreciation, non-cash expense, and there is no taxation. Why we have not taken head office cost, total head office cost is not affected. Right. Now you can ask me the doubt. Anybody any doubt on this question? Till now the question is not over. We have to do sensitivity analysis for three variables. One is life of the project, second is sales volume, third is material cost. First we'll write sensitivity analysis with respect to product life. Sensitivity analysis with respect to product life. Under that we'll write calculation of discounted payback period. Already explained to you. Discounted payback period means the minimum time required to recover your initial investment. Okay, format is same. Today for the second time we are doing it. Question is very, very important. Year, cash flow, discounting factor at 5%, discounted cash flow and cumulative discounted cash flow. Last column is cumulative discounted cash flow. If you don't want to write discounted cash flow, you can write present value. Is it right? So like the previous question, this time it is a 5-year problem. 1, 2, 3, 4, 5. Cash flow, cash inflow 87,000, already calculated 87,000. 5 times. Discounting factor at 5%, 1 divided by 1.05 equal to multiply. Again I will give you a shortcut. You have to multiply by a constant number 87,000. First time 87,000 into 0.9524 equal to. Next time only type the factor and press equal to, you will get the answer. Again type the factor, press equal to, type the factor, press equal to, type the factor, press equal to. That way you can do it faster. Now the next column is cumulative discounted cash flow. First number will be same, this plus this, 161,768, this plus this, 236,919, 236,919, 236,919 plus this number. If once you have crossed 2,50,000, once I have crossed my initial investment 2,50,000, further calculation can be avoided. After this, even if you write anything here, it won't affect your answer. Okay. So in 3 years, we are able to recover 236,919. In 4 years, we are able to recover 3,08,494. Somewhere between 3 and 4, you are going to recover your initial investment. Now my question is, what is the discounted payback period? You will have to answer 3 point something. Come on. I am waiting for you. What is discounted payback period? You will have to try first. You can refer the previous answer if required. Please try. You must have done this so many times in your intermediate capital budgeting. One student is saying 3.05. Anybody else? So the answer is 3.18. The answer was 3.18. Okay, 3 year plus you have to recover 2,50,000 minus 236,919 divide by this number. So this calculation will give you 0.18. Please check and confirm. Is it 3.18? Yes, 3.18 is right. Very good, Divya. Very good, Sajid. And therefore margin of safety is, my original estimate is 5 year. Minimum project should run for 3.18 years. So I have a margin of safety of 1.82 years. Margin of safety divided by initial estimate is sensitivity percentage. Please write sensitivity percentage equal to 1.82 divided by 5 into 100. Are you getting 36.4%? Are you getting 36.4%? Yes, 36.4% is right. 36.4% is right. Since you are a good student, all students are good. My question is, next question number 2, sensitivity analysis with respect to quantity sold. You have to tell me what is the minimum quantity to be sold, or the quantity to be sold at which NPV will be equal to 0. I am asking you a simple school level mathematics question. What is the quantity to be sold at which NPV would be 0? At which NPV would be 0? The answer is not 10,000. 10,000 gives you positive NPV. I want something lower than 10,000 quantity at which NP will be 0. Please try. I'll wait. You need to try yourself. Take a page, paper, pencil, calculator and try. What is the minimum quantity, or that quantity to be sold at which NPV will be equal to 0? Yes, please reply. Please reply. What is the quantity to be sold so that your NPV is 0? It is not difficult. You can do it. One student has replied, I have started receiving answers. One person is saying 8700. Okay, any other answer? I don't know. I don't remember each and every answer and come to the class. Not possible for a human being. We'll check. Any other answer? Any other answer? One student has replied 11,363. That cannot be the answer because it has to be less than 10,000 quantity. At 10,000 quantities sold, we have positive NPV. So NPV will be 0 when the quantity sold is less than 10,000. So you can't answer more than 10,000. That is a gross mistake. 8700 is also a mistake, but that is to some extent acceptable. Okay. So we will solve. You were given sufficient time. There are two ways I can solve it. One is by preparing this statement and second is by writing an equation. And then whichever way it helps you, it's okay. So below that write sensitivity analysis with respect to sales. sensitivity analysis with respect to sales. So first thing you have to understand, my cost of the project, don't write, only understand, is 2,50,000. So my PV of cash inflow should also be 2,50,000. PV of cash inflow is equal to PV of cash outflow, means my NPV is 0. To get a PV of cash inflow 2,50,000, I need to find out what will be my annual cash inflow. Annual cash inflow will be 2,50,000 divided by PV annuity factor 5% and 5 year. So that will give me annual cash inflow required. To the annual cash inflow required, if I add 13,000, which is fixed cost, I will get contribution required. I will get total contribution required. We have seen in the earlier calculation, the contribution is 10 rupees per unit. So if I divide by 10, I'll get quantity to be sold, so that we will get this much contribution. From this contribution, if I deduct this cash inflow 13,000 fixed cost, I'll get cash inflow, and that cash inflow when multiplied by annuity factor will give me an amount equal to 2,50,000. So I have to do reverse working. Reverse working means start from 2,50,000. Cost of the machine is 2,50,000. Required PV of cash inflow is 2,50,000. Is this understandable? If these two numbers are equal, if A is equal to B and PV is equal to 0, and to get the inflow 2,50,000, I need to divide by the annuity factor, so that I will get annual cash inflow. Write down PV annuity factor 5% 5 year. Already we have computed that. 4.3295. Therefore annual cash inflow required. B divided by C. You can just write B divided by C. 57,743. Annual cash inflow is arrived at by calculating contribution minus fixed cost, relevant fixed cost. So if I add back that fixed cost, of 13,000, I will get annual contribution required. Which is 70,743. Contribution per unit was 10 rupees. Calculated originally. You can see, to get a contribution of this amount, per unit contribution is 10, you need to sell 7,074.3, but we'll round it off on the higher side. Why we will round off on the higher side? Anything less than 7074.3, anything less than that will result into negative NPV. So always the rounding off will be on a higher side. 7075. That is my minimum quantity to be sold, so that your NPV will be 0, not negative. So how much margin of safety do we have? My original estimate is 10,000. Minimum quantity to be sold at which NPV will be 0 is 7,075. So I still have a margin of safety of 2,925. Even if my sales quantity per annum goes down by 2,925, my NP will be positive, okay, or 0, but not negative. That helps me to understand the risk. The risk is that if sales quantity goes down by 29.25%, your NP will be 0. but if it falls by more than that percentage, your NPV will become negative. Are you comfortable with this 29% margin of safety? If yes, you can go ahead with the project. If no, then you have to review the project again. Is it right now? Hello, is it right? Is 7075 right? Or did you get a shock? All intelligent students will be tested today. If you think you are intelligent, this chapter is for you. Sensitivity analysis. Okay, very good. Let us solve this part again by one equation. Okay. In case if you are interested in solving an equation, alternatively what we'll do, we'll write an equation. PV of cash inflow is equal to cost of the machine. If this equation is satisfied, NPV will be 0. And how do you compute cash inflow? Let quantity to be sold be X. Let quantity to be sold be X. Is it right? So my total contribution will be X into, what was my contribution per unit? 10x. My total contribution will be 10x. 10 is the contribution per unit, quantity sold is X, minus my relevant fixed cost 13,000. Contribution minus fixed cost will give you cash inflow, and that multiplied by PV annuity factor 5%, 5 years, and this should be equal to 2,50,000. Contribution minus fixed cost is my cash inflow. Contribution is equal to 10 rupees per unit into quantity sold X. Can you solve this equation? Can you solve this equation? Please try. Please try solving this equation. Yes, Divya, please try solving this equation. 10x minus 13,000. What was the annuity factor? I have to check. 4.3295. 4.3295 is equal to 2,50,000. Okay. Which means 10x minus 13,000 will be 2,50,000 divided by 4.3295, which means 10x minus 13,000 is equal to, you are doing the same thing, 57743, 57743, which means 10x equal to, add this number, this will become 70743. So x will be equal to, divide by 10, 7074.3, say 7075. We are doing the same thing. That was vertical. This is horizontal. Okay. Very good, Anup. So this is also you can say, but this is not the answer. You have to write margin of safety, you have to write sensitivity percentage. But once you get this number, you can compute margin of safety and sensitivity percentage. Okay, one more chance I will give you. Don't worry. Next question is sensitivity analysis with respect to material cost. My learned student will now try sensitivity analysis with respect to material cost per unit, which means what should be material cost at which NPV will be equal to 0. What should be material cost per unit? What should be material cost per unit at which NPV will be equal to 0? What will be material cost per unit at which NPV will be 0? So the student has to answer material cost per unit. I'll give you 30 seconds to think. 30 seconds starts now. In the same way you can solve. In the same way you have to solve, but you have to write your own equation. I am waiting for your answer. I am waiting for your answer. Treat it as a class test. Show your intelligence. Let the world know that you are intelligent, otherwise they will laugh at you. If you don't reply and if it doesn't come in the recording, outsiders will think these students do not have intelligence. What should be material cost at which NPV is 0? Sajid Khan, please reply. Rajesh, reply. Bapat, reply. Hari, please reply. Where is your intelligence? You are working so hard in the offices. In case if you don't want to reply, you can inform me. Unnecessary, we are wasting our time. One student has replied 7.45. 7.45. Okay. I won't say whether it is right or wrong. Let others also try. Time over. I will solve, you will check. Because the paper is of 3 hours only, you have to solve in the given time period. Still, if somebody wants to reply, you can. I am waiting for 2 more seconds. If you want to reply. Write down. Now I will solve. Sensitivity analysis with respect to material cost per unit. Sensitivity analysis with respect to material cost per unit. Please, you have to work hard on the intelligence front. Just uploading GST return is not enough. You have to apply intelligence. In the previous case too, we have already found out that you require a minimum contribution of 70743 so that your NPV is 0. I don't want to repeat those 5 lines again. Have you understood? You need a minimum contribution of 70743 at which your NP will be equal to 0. Sales volume 10,000. Only one variable will be changed at a time. Only one variable will be changed at a time. So now the sales volume will be 10,000. Then the next is contribution required per unit. In order to earn 70,743 contribution, your sales volume 10,000, contribution per unit has to be 7.043. And what is my total variable cost? Total variable cost per unit required. Total variable cost per unit required. Your selling price is 22. Selling price is 22. Contribution is 7.0743. All of you have studied in your costing. Selling price minus contribution per unit will give you variable cost per unit. So I need a total variable cost of 14.9257. Under that, labor cost and variable overhead we are not going to change. Labor cost is 5. Labor cost is 5. Variable overhead is 2.5. And the third component of variable cost is material, which will be balancing figure. So this is my total variable cost minus labor minus variable overhead. So the balancing figure is material cost per unit. Material cost per unit comes to 7.4257. 7.4257. One student has replied 7.45. That was quite close. That was quite close. Maybe you have rounded off. If you have done like this or any other way, then it is okay. So my material cost can increase to 7.4257 and my NP will be 0. Margin of safety. Margin of safety will be 7.4257 minus 4.50. 2.9257, and therefore sensitivity percentage H upon G into 100, H upon G into 100, H upon G into 100. Can you tell me margin of safety percentage now? Margin of safety percentage H upon G. Yes, please. 65%. Oh my God. So here we have lot of margin of safety. So risk is less when it comes to material cost, because here we have a very high margin. Suppose you find this difficult. We are going to solve it by one more alternative way, whichever helps you to understand. My objective is to make you understand. Write down alternatively. In the exam, don't try both. Only one is enough for the exam purpose. But for understanding, whichever helps you to understand better. Sensitivity analysis with respect to material cost per unit. So you will write, let material cost per unit be X. Let material cost per unit be X. Now how to write the equation? Like the previous one, my sales quantity is 10,000. Selling price is 22 rupees. Selling price is 22 minus material cost X minus labor cost 5 minus variable overhead 2.50. So this gives me contribution. What I have written inside the bracket gives me contribution. 10,000 into contribution will give me total contribution. Will give me total contribution minus 13,000 rupees fixed overhead. minus 13,000 fixed overhead. So this will give me annual cash inflow multiplied by PV NBT factor 5% 5 year, and that should be equal to 2,50,000. That should be equal to 2,50,000. Is it right? Now you can solve it. So to simplify 10,000, this is 22 minus 5 minus 2.5. How much is that? 14.5 minus x minus 13,000 and this you can write 2,50,000 divide by that factor. How much was that factor? Let me check. 7.0743 factor I forgot. Anybody can tell me the factor? 4 point. What was the factor for 5% 5 year? You are not replying only. So difficult to teach in a non-responsive batch. 4.3295. Is it right? 4.3295. And then I am going to add 13,000 on the right side. So 2,50,000 divided by 4.3295 plus 13,000 is equal to 10,000 into 14.5 minus x equal to 70743. Then 14.5 minus x will be equal to 7.0743 because I will divide by 10,000, and x will be equal to 14.5 minus 7.0743. Very good. 14.5 minus 7.0743. You are getting same answer, 7.4257. This is your material cost per unit required. Okay, this is your material cost per unit required. We have done the same thing. It is horizontal, that was vertical. Whichever method you understand, you please apply. Okay, some students are good with solving equation, some are not so good with solving equation. So I have solved by both the methods. Now it is up to you how much you can take from it and move ahead. This question is one of the most likely questions for your upcoming exam. Oh, welcome to question number 38. Question number 38. Little different than the previous two questions. Cash flow of a project are set out below. Similar question is in the study material. Right? Similar question in study material. Similar question in study material. Keep the calculator ready. I will require your numbers. Cash flow of a project year 0, 1,40,000. Cash saving is given, means inflow. Running cost means outflow. And they have written in bracket also for your benefit. The discount rate is 15%. Applying DCF method, discounted cash flow method. Present your explanation as to how sensitive is the project to the variation in capital cost. Capital cost means this one, project cost. to what extent the project cost can rise. Saving, this means test it for saving also. And third, running cost, how much running cost can rise. Still my NPV is 0. How much cash saving can fall? Still my NPV is 0. How would you rate the risk in the project? That is something new. How would you rate the risk in the project? Means we'll have to rank these three numbers. The one which has lower sensitivity percentage, the project is more risky with respect to that factor, and the one which has higher sensitivity percentage, the project is less risky with respect to that particular variable. But first thing first, I need to find out the NPV of the original project, NPV of the original data, and then I will tell you how to do sensitivity testing. So please write down, my dear learned student, calculation of NPV of the original project. Calculation of NPV of original project. Calculation of NPV of original project. Write down this format first. Format has 6 columns. Year, cash saving, PV of cash saving at 15%, PV of cash saving at 15%, running cost, PV of running cost at 15%, and the last column is net present value. Last column is net present value. So this table will help me to answer all the 3 questions very fast, because I have to test cash saving also for sensitivity. I have to test running cost also for sensitivity. So while solving, you have to think how you can design the answer to save time. Have you noted whatever information is given in the problem? I have not done anything from my side. Now we are going to calculate present value of 2 lakh at 15%. So how are you going to do it? You are going to first type 2 lakh divide by 1.15 equal to memory plus 173913. Then type 3 lakh divide by 1.15 2 times equal to memory plus 226843. Then you type 2 lakh divide by 1.15 3 times equal to memory plus 131503. Memory recall, this is 532259. Okay, now come to running cost. Running cost 1,50,000 divide by 1.15 equal to memory plus 130435. 1,80,000 divide by 1.15 2 times equal to memory plus 136106. Next, 1,60,000 divide by 1.15 3 times equal to memory plus 105203. Memory recall, this is 37174 3 or 4 you can write. 4. Right. Now we'll compute NPV. 173,913 minus 130,435 equal to 43478 memory plus, then 226,843 minus 136,106 equal to memory plus 90737. Next one, come on, 131,503 minus 105,203 equal to 26,300. Add these three number minus 1,40,000 so that is 20,515. Now please check the calculation and confirm if it is right. Last column is the difference between PV of cash saving and PV of running cost. Is it right? Anybody who can confirm, is it right? Yes. So what is my NPV? 20,515. Underline, highlight. So this is like my margin of safety also. Now understand the logic. In next 2 minutes the answer will be over. This cost of the project is 1,40,000. If this increases by 20,515, if this increases by 20,515, NP will be 0. So my margin of safety for cost of the project is 20,515. For the cash saving, this is my PV of cash saving. This is my PV of cash saving. Correct? This is my PV of cash saving. If this reduces by 20,515, my NP will be negative. So my margin of safety is 20,515 for PV of cash saving, and you have to divide by this number. Similarly, for running cost, if this PV of running cost increases by 20,515, oh my God, I have removed it. So sad. If the PV of running cost increases by 20,515, my NP will become 0. So my margin of safety is the same NPV, but when we'll divide by the PV of running cost. Is it right? So please solve yourself now. Please solve yourself. Write down sensitivity analysis. Sensitivity analysis. First write down with respect to project cost. With respect to project cost. So sensitivity percentage will be equal to NPV divided by project cost. NPV. Yes, Divya, what was NPV? NPV, can you tell me NPV? 20,515. Okay, cost of the project is 1,40,000 into 100 into 100. So the answer is 14.65%. Yes. Now write down with respect to cash saving. With respect to cash saving, NPV divided by present value of cash savings. NPV is 20515. Can you please tell me the PV of cash saving? 530 to 259 into 100 percentage 20515 divided by 532259 into 100, 3.85%. Is it right? 3.85%. Okay, very good. Now write down with respect to running cost. Same formula, NPV upon PV of running cost. When different years have different cash flows, we will simply compare NPV with the present value of that cash flow. So that NPV is 20515. And how much was PV of running cost? Anybody? PV of running cost was 364 into 100. Anybody answer? Answer. 5.46. 5.46%. 5.46%. Very good. Now you write down which is the lowest and which is the highest. So make a summary. Under summary, 2 columns, variable and sensitivity percentage. Variable is project cost, 14.65%. Cash savings, 3.85%. Running cost, 5.46%. Write down one note below. The project is most sensitive to cash savings. Can you see that? Project is most sensitive to cash saving because your margin of safety in percentage is very low. A 3.85% fall in cash saving can result into 0 NPV, and more than that will result into negative NPV. So project is more sensitive to cash saving and least sensitive to project cost. Project is most sensitive to cash saving and least sensitive to project cost. Is it right? Can we go to the next one? Yes. Now write one more note. For calculating sensitivity we are dividing NPV by present value of cash saving or present value of running cost, because all these are in present value terms. All these are in present value terms because all these are in present value terms. Is it right now? So this was my question number 38. Question number 39, homework. Just read the problem yourself, read the question 39, same to same question, only figures are different. In fact, much simpler because you have only 2 years, whereas I had taken 3-year problem. Question number 39, homework. Then question number 40, homework. Same question, 100% same question, figures are different. Only institute have changed the numbers. That is the creativity of your dear institute. Just see the question number 40 and tell me if you can do it. Can you do it? Keep about 4 pages blank to do the homework. Write in the notebook question number 39, homework, question number 40, homework. I will do it. I want to do it. I can do it. Now we'll come to question number 41. May 22 exam, 5 marks in intermediate exam, but relevant for you now. The topic has been shifted to your course now. So in case if you think, no, this is beyond my dignity to solve intermediate problem, you can skip it, your choice. You can come back after 8 minutes. Okay. But if you are genuine good candidate, you will stay and you will solve. 5 marks question. P Limited is considering a project with the following details. Initial project cost 1 lakh. Annual cash inflows, they are different in different years. So I need to compute their present value and then NPV divided by present value of cash inflow will give me sensitivity percentage. Life of the project 4 years, cost of capital 10%. Measure the sensitivity of the project to change in initial project cost. Same, NPV divided by 1 lakh. Annual cash inflow, NPV divided by PV of annual cash inflow, considering each factor at a time such that NPV becomes 0. So sensitivity testing has to be done such that NP becomes 0. Identify which of the two factors the project is most sensitive to affect the acceptability of the project. So the one which will have lower sensitivity percentage, the project is most sensitive to that variable. Is it right? And to help you, your dear and kind institute has given you factors also. So are you ready to solve this wonderful question? Say yes. Write down calculation of NPV of the original project. Calculation of NPV of the original project. 4 columns only: year, cash flow, PV factor at 10%, PV factor at 10%, PV. P factor is given, so I am going to use it. Year, write down 0, 1, 2, 3, 4. It's a 4-year project. Cash flow, write 1 lakh in bracket, then 30,000, 40,000, 50,000, 60,000. Factor is given Say thank you to the institute. Dear institute, thank you for providing us factor. Because of your factor only I could become CA. Okay. So this is my factor. Now use your calculator and memory plus also. 30,000 into 0.909. Memory plus 27270. 40,000 into 0.826 equal to memory plus 33040. 50,000 into 0.751 equal to memory plus 37550. Then 60,000 into 0.683 equal to memory plus 40980. First you put these four numbers in one box and write the total below 111570, and then write down NPV will be 111570 minus 1 lakh, 11,570. 11,570. Please just confirm, is it right? These four numbers you put in a box like format. You got NPV, you got PV of cash inflow also, you got cost of project also. Very easy question. Something is wrong? Just confirm. I think total is wrong. Yes, because one number I have not transferred to memory plus. So the total you are saying 138840 and NPV will be 38440. Very good. 38440. Now below that I have to do sensitivity testing for two variable. Write down sensitivity analysis A with respect to first item is initial project cost. With respect to initial project cost, write down sensitivity percentage equal to NPV divided by initial project cost. NPV is 38840 divided by 1 lakh into 100 is 38 point, how much is that? 84%. And then write down B with respect to annual cash inflow. Sensitivity percentage equal to NPV upon PV of cash inflows. Format should be designed in such a manner that you are able to get all the numbers in that format. You don't have to work hard again. Like for example, we did that 138840. Otherwise, you will have to do the calculation again and waste your time. 38840 divided by 138840 into 100, that is 27.97%. So write down note, project is most sensitive to which variable? Come on, fill in the blanks. Project is most sensitive to cash inflow or project cost? Project is most sensitive to cash inflow or project cost? Come on, the one which is lowest is most sensitive to annual cash inflow. Very good. most sensitive to annual cash inflow, because margin of safety is lower. Margin of safety is lower. Because margin of safety is lower. Right? All of you are right, those who have replied cash flow. Relatively, annual cash flow will impact the project more because we have less margin of safety. So that was a question, simple question. We can expect such basic question in the exam. And note, write down, NPV is divided by PV of cash inflows, because both are in present value terms. Because both are in present value terms. Both are in present value terms. Right. Now we'll take a 16-mark question which was asked in May 2007 exam, and it is there in your, I think, study material also. So again, write down, very, very important in case if you are appearing in the upcoming exams, this question is very likely. Okay. So question number 42. ASF Limited is considering a project for which the following estimates are available. So in the previous problem they had done the cash flow calculation and given to you. Now this time you have to do it. That's the difference. And there are more variables to be tested this time. Your initial project cost is 10 lakh, selling price 60, cost is 20. So can I say contribution? You can write contribution will be 20. 60 minus 40, contribution is 20. Sales volume is given 20,000, 30,000, 30,000. So multiply sales volume by contribution. You will get cash inflows 4 lakh, 6 lakh, 6 lakh. There is no fixed cost in the problem. Enjoy. Discount rate is 10% per annum. Right. What more do you want? You are required to measure the sensitivity of the project in relation to following parameters. First is selling price per unit. This is 60 right now. You make it X and find the value of X at which NPV will be 0. Find the value of X at which NP will be 0 and you will get the first answer. Unit cost means this 40. So you can put this as X and find the value of this unit cost at which NP will be 0. And the next is sales volume. Sales volume, and this I will tell you later. Initial outlay we have done several times. Initial outlay is NPV divided by initial outlay will give you sensitivity for initial cost of the project. And project lifetime, I have told you, you have to compute discounted payback period. Is it right? You have to compute discounted payback period. So this is the question, highly important for exam, but first we will check original NPV based on original data. If that is positive, then it makes sense to do sensitivity analysis. If that itself is not positive, then there is no point. Is it right? Kindly reply. Draw this format first. Draw this format first. Year cash flow, discounting factor at 10% and present value. Column number 1, 2, 3, 4. 4 is equal to 2 into 3. Everybody will reply. This is a very good question on the screen. So first you write down year 0, 1, 2, 3. Year 0, 1, 2, 3. In year 0 you have investment of 10 lakh. Then year 1 you will write there in bracket. I have not written, but I will instruct you to write 20 rupees into 20,000. 20 into 20,000, 4 lakh. Year 2, 6 lakh, right? 20 into 30,000. 20 into 30,000. 20 into 30,000. Below that, right? Again, 20 into 30,000, 6 lakh. Later on, you will ask me this question, how 6 lakh has come. 20 rupees is the contribution and 30,000 is the quantity. Now apply the factor. Please apply 10% factor, or you can write directly in the last column if you want. Directly in the last column, 10 lakh, 4 lakh divided by 1.10, 363, 640, 6 lakh divided by 1.10, 2 times equal to. Approximately check. Approximately, because I am writing in 4 digits. You may be directly doing it. Answer can be different by few rupees. 495, 840. Then 450, 780. 450, 780. Total 3,10,260. 3,10,260 approximately. Write approx. It can be more or it can be less. Are you getting approximately same answer? Plus minus 100 or 200 rupees also okay. Just confirm, then I'll go to the next discussion. Is the answer right? Is the answer right? Okay. Approximately the answer is right. Now write down sensitivity analysis with respect to sales price. Sensitivity analysis with respect to sales price. Let sell price per unit be S. Let sell price per unit be S, so that the project would break even. So that the project would break even with 0 NPV. So that the project would break even with 0 NPV. So first chance should be given to the student. Otherwise, you will not be able to apply your own original thinking. So my question is, the student has to answer what should be the selling price, what should be the selling price at which NPV will be 0. I hope you understood my question. First I will ask you to try. Otherwise you will think that we are only copying. Try. First 30 seconds to you also. You will try, I will wait, no problem. What is the selling price per unit at which NP will be 0? Done? Please reply. Anybody who wants to reply? If you reply, then only we can go ahead. Students are waiting for me. I am waiting for them. Is it so difficult that none of you are responding? What is the selling price at which NPV will be 0? You have to solve an equation. Okay, so write down the equation and I will explain the equation to you. Your NPV will be 0 when PV of cash inflow is equal to PV of cash outflow. My outflow is 10 lakh. The present value of cash flow of the first year, understand the first year, 20,000 is the unit into selling price assumed as S minus 40 is the cost price, and this will be multiplied by present value factor of 1 year, 0.9091. So if you multiply these three numbers, this will give you PV of cash inflow of the first year. Same thing, 30,000 quantity into S minus 40 into second year PV factor will give you PV of cash inflow of the second year, and the same thing here also, 30,000 into S minus 40 into 0.7513. So now I hope you are a final level student. You will be able to solve the equation. If you are able to solve on your own, it is good. If you are not able to solve, write down S equal to 55.26. Anybody who got the answer? Anybody who got the answer? 55.26. Please confirm, because I can't solve the equation. This is not appropriate at this final level. You have to multiply these three, multiply these three, multiply these three numbers, add them and solve it. Okay, so this is 55.26. Later on you can check as homework if you are still not able to get it. Margin of safety equal to, margin of safety equal to, my original estimated selling price is 60. I need minimum 55.26. So margin of safety 4.74. Next line, margin of safety in percentage. Margin of safety in percentage 4.74 divided by 60. 4.74 divided by 60, 7.9%. 7.9%. Margin of safety 7.9%. Is it right? Say yes or no. 7.9%. Yes. Now I am going to ask you the same question. Sensitivity analysis with respect to cost per unit. With respect to cost per unit. Please respond. Sensitivity analysis with respect to cost per unit. Or you can just tell me the minimum cost required, or the cost, maximum cost, not minimum. What is that cost per unit at which NP will be 0? What is cost per unit at which NPV is equal to 0? Why are you not responding? I am not understanding. If I am asking you to try and think, you are not trying. What is cost per unit at which NPV is 0? One student has replied, very good, 44.74. That is the answer given by a student, 44.74. One more student, 44.74. Very good. Which means now you have started understanding. There is a shortcut to arrive at that answer. So selling price is 55.26. Cost is 40. So contribution required is 15.26, which means I will break even when contribution is 15.26. So in the second answer, my selling price will be 60, contribution needed is 15.26. So I don't have to solve an equation, I have to just use my logic. If in the previous answer which is on the screen, my contribution required is 15.26, in the second answer also my contribution required will be 15.26, selling price is 60, contribution required 15.26, therefore cost per unit required is 44.74. Very good answer. That way you have to think. Write down below nicely sensitivity analysis with respect to unit cost. Don't solve the equation and invest your time, not required. Sometimes smart work is important than hard work, and this is one example where smart work is required. From the previous example, minimum contribution required is equal to go to previous step, and there we have got selling price 55.26, 15.26. So whether your selling price changes or whether your cost price changes, I need a contribution of 15.26 per unit so that my NPV is 0. Next line, required cost to obtain contribution. Required cost to obtain contribution of 15.26 is equal to 60 minus 15.26. 60 minus 15.26 is equal to 44.74. 44.74 is the upper limit of the cost per unit I can tolerate. Margin of safety 44.74 minus 40. 44.74 minus 40 is 4.74. 4.74. Therefore sensitivity percentage will be 4.74 divided by 40. 11.85%. 11.85% is the answer. Next is sensitivity analysis with respect to sales volume. Sensitivity analysis with respect to sales volume. Sales volume will affect my cash inflow. Sales volume will affect my cash inflow. So which two number I am going to compare? I am going to compare NPV with the present value of cash inflow. NPV with the present value of cash inflow. NPV I have already computed. Present value of cash inflow will be NPV plus initial investment. Am I right? NPV plus initial investment. Because my sales volume is going to affect my cash inflow. So my PV of cash inflow, go to the original answer. You have investment 10 lakh and you have NPV 3,10,260. Either you can add these two numbers or you can add those three inflow, present value of those three inflow of year 1, 2, 3. You will get the same result, 13,10,260. NPV plus initial investment is PV of cash inflow, or you can add year 1, year 2, year 3 PV of cash flow. You will get the same answer. Then write down PV of cash inflow at which NPV is 0 is 10 lakh. If cash inflow reduces to 10 lakh, my NP will be 0. So I have a margin of safety. I have a margin of safety equal to 3,10,260. Even if sales volume drop, and because of that my PV of cash inflow drops by 3,10,260, NP will be 0. Therefore sensitivity percentage 23.68%. 23.68% sensitivity percentage. But one assumption we are making, in the given question your sales volume is different in different years. So we are assuming that sales quantity will vary proportionately in all the years. Sales quantity will vary proportionately in all the years. Otherwise you can test 1 year at a time also. Then you will have to solve 3 times. By what percentage sale of year 1 can fall? By what percentage sale of year 2 can fall? By what percentage sale of year 3 can fall? In that case, if you want to test for individual year, then you will have to do it 3 times. But if I look at the institute answer given in your book, which is taken from the study material only, or if I look at the original suggested answer, they have taken proportionately only, assuming that sales of all the 3 years will change proportionately. Okay, now the next is sensitivity analysis with respect to initial outlay. Sensitivity analysis with respect to initial outlay. Here I am going to simply divide NPV by initial investment. If you want to draw the table, you can, otherwise you just write down sensitivity percentage equal to NPV upon initial investment. NPV is 3,10,260. Initial investment is 10 lakh. Therefore, sensitivity percentage is approximately 31.03%. Sensitivity is approximately 31.03% with respect to initial outlay. Directly also you can write the equation NPV upon initial investment. Now one more thing is sensitivity analysis with respect to product life. Sensitivity analysis with respect to product life. What we will calculate? Whenever product life is asked, you will calculate discounted payback period. You will calculate discounted payback period. Under discounted payback period, we have decided to follow this format: 5 columns, year, cash flow, discounting factor at 10%, discounting factor at 10%, discounting factor at 10%, discounted cash flow, cumulative discounted cash flow, cumulative discounted cash flow. Then we have 5 columns, 1, 2, 3. These are column numbers, 1, 2, 3. 4 is 2 into 3, 5. Okay, and you will solve year 1, 2, 3 only. 3 years are there. 1, 2, 3. Cash flows, original question 4 lakh, 6 lakh, 6 lakh. In the original question, discounting factor at 10% already calculated 0.9091, 0.8264, 0.7513. Even this column we have computed in the original answer. You can copy from there. 363 640, 498 540, 450 780. Smart student will not calculate. He has already done it. He will just copy it from there. And now compute the cumulative cash flow. 363 640, 859 480, 1310260. In year 2 you can recover this amount. In year 3 you recovered this amount, but I need to recover 10 lakh. 10 lakh will be somewhere between 2 and 3 year. So write down discounted payback period is equal to 2 year plus. You have to recover 10 lakh. In 2 years you have recovered 859 480 minus 859 480, but the third year cash flow is 450 780. So the proportionate period required is how much? 2.31 years. Very good. 2.31 years. Is right, 2.31 years approximately. Which total is 862 180. One student is saying total is 862 180. This one. Okay, change it. Let me also check. Please wait a minute. I have to check one number. I think this number is 495840. First you multiply these two. 495840. 495. First you confirm this number. Is it right? 495840. This is right. If this is right, 495840, maybe the typing mistake has happened here. Instead of 58, I have typed 85. Now it is right. Is this answer also right? Yes, this is also right. So please rectify this figure. It should be 495840. Okay, let us go to the answer. 2.31. Very good. 2.31 years. 2.31 years. Margin of safety, write down. Original estimate is 3 years. Minimum time required is 2.31 year. So margin of safety is 0.69 years. Margin of safety is 0.69 years, and therefore sensitivity percentage will be 0.69 divided by 3. 0.69 divided by 3 is 23% approx. Some rounding of difference is okay. Is it right now? Is this right? This answer is now over. So we can now go to next question. 43 exam question. Write down very important again. They have already asked in the past exam of CA final, and it is there in the study material also, so that makes it even more important. So this I will give you classwork, or you can say break time. Those who want to try, you can try in this 10 minutes, and those who want to enjoy break, you can enjoy 10 minutes break. The choice is yours. We will meet after 10 minutes. Try yourself if you can. Okay, can we start now? If you have done, then you will check the answer. In case if you have not done, then you will follow me. This is one of the very good question which is based on reverse working. They have given you the sensitivity percentage and the student has to work reverse and find the original information. The easygoing company is considering a new project with initial investment for a product survival. It is estimated that the IRR of the project is 16%. So this is a very important hint. IRR is that discount rate at which NPV is 0. IRR is that discount rate at which NPV is 0. IRR is that discount rate at which PV of cash outflow is equal to PV of cash inflow. Life of the project is 5 years. The financial manager has studied the project with sensitivity analysis and informed that annual fixed cost sensitivity is 7.8416%. What do you mean by this? It means that if fixed cost increases by 7.8416%, if fixed cost increases by 7.8416%, NP will be 0. Second, whereas the cost of capital, that is discount rate sensitivity, is 60%. It means if the cost of capital, which is X, increases by 60%, your NP will be 0, 1.6x. If the cost of capital becomes 1.6 times, NP will be 0, but they have written IRR of the project is 16%, which is simply a hint that 1.6x is 16%, because at 16% NPV is 0. If cost of capital increases by 60%, NP will be 0. So these two rates are equal. So indirectly you can calculate the cost of capital or discount rate very easily by equating 1.6x with 16%. Other information are profit volume ratio is 70%. It means contribution upon sales is 70%, which means variable cost upon sales is 30%. Two information given simultaneously, and variable cost is given 60 rupees. Now tell me, if variable cost is 60 rupees, variable cost to sales ratio is 30%, can you not find out the selling price? Can you not find out the selling price? Can you reply please? What will be selling price? What will be selling price? 60 divided by 30%. Anybody for selling price? Anybody for selling price? The selling price will be 200 rupees. Very good. Selling price will be 200. Annual cash inflow is 57,500. If annual cash flow is discounted at IRR of 16%, if annual cash flow is discounted at IRR of 16%, that will give me PV of cash inflow. But PV of cash inflow is equal to PV of cash outflow if the discount rate is IRR. So we can find out initial investment in the project also. Initial investment in the project is simply 57,500 into PV annuity factor at 16% and 5 year. This will give me PV of inflow, but that is also equal to cost of the project. Is it right? Once you get cost of project, you can compute NPV also. Annual cash inflow is 57,500. Using IRR and using cost of capital sensitivity, your cost of capital will be 10%, and you can find NPV also. Then you can find annual fixed cost using the sensitivity of fixed cost given to you. You can compute annual unit of sale also. All this will require you to solve equation, and then you can compute break even units also. Break even units. But first thing first, I need to find out initial investment of the project. Annual cash inflow is given, IRR is given, and therefore we can find out PV of cash inflow, and PV of cash inflow is equal to PV of cash outflow, and that is equal to initial investment. So please write down in the notebook. Good student will write, okay, and smart student will only observe as if he has understood everything by observing. We are writing it for you only. So please write down in the notebook, take out a notebook and write. At IRR, PV of cash outflow is equal to PV of cash inflow. Then write down, outflow means initial investment only. Initial investment equal to 57,500 into PV annuity factor at 16% 5 year. Factors are given in the problem. So you can add those factors at 16%. You can add those factors at 16% if it is given. If not given, then do it yourself. 3.274. Answer please. Please be little proactive and answer. Check 188,255. Is it right? 188,255. 188,255 is right. Very good. Now write down step number 2. Calculation of cost of capital. Cost of capital we have to find. You are given IRR 16%. You are given sensitivity of cost of capital is 60%. Sensitivity of cost of capital is 60%. IRR is 16%. What does that mean? It means if your cost of capital increases by 60%, NP will be 0, and IRR of 16% means at that discounted NPV will be 0. So let us assume cost of capital be X. Let us assume cost of capital be X, which means if cost of capital increases by 60%, it will be equal to 16, that is IRR. It will become equal to IRR because at IRR NPV is 0. 1.60x equal to 16. 1.60x equal to 16, and therefore x equal to 10%. So this is my cost of capital. NPV is calculated using cost of capital as a discount rate. NPV is calculated using cost of capital as a discount rate, not IRR. If you take IRR, it will be 0. Then there is no need of calculation only. Now write down calculation of NPV. This is one of the answers required. Calculation of NPV. Write down NPV equal to PV of cash inflow, PV of cash inflow minus PV of cash outflow, minus PV of cash outflow. PV of cash inflow will be annual cash inflow into PV annuity factor at 10%, 5 year minus 1,88,255. Solve. Give me the answer. Solve and answer, please. Anybody answer? Approximately check. Approximately the answer is 29,727.50. Is right? Very good. 29,727.50 is NPV. Any query on this? Now write down calculation of annual fixed cost. Calculation of annual fixed cost. Sensitivity of annual fixed cost is 7.8416%. Sensitivity of annual fixed cost is 7.8416%. I'll give you 30 seconds to try your luck and tell me what is your originally estimated fixed cost. What is the original fixed cost? I will give you a hint. If fixed cost increases by 7.8416%, NP will be 0. Other variable kept constant. Please try. Only if you try you will learn. I'll wait for 30 seconds. What should be annual fixed cost? What should be annual fixed cost? Anybody answer? What should be annual fixed cost? One student has replied 1 lakh rupees. You are right. There are different ways you can reach that answer. If your answer is 1 lakh, then you are right. So write down below, this is my way of presentation. Your presentation can be different. Answer has to be 1 lakh. Right? It means if annual fixed cost rises by 7.8416%, rises by 7.8416%, NPV will become 0. NPV will become 0. NP will become 0. Let annual fixed cost be F. Let annual fixed cost be F. Let annual fixed cost be F. So I will write an equation. This is my annual cash flow given in the problem. If fixed cost increases by 7.8416%, my annual cash inflow will reduce by 0.078416 F. 0.078416, 7.8416% of F. Increase in fixed cost will reduce the cash flow. Increase in fixed cost will reduce the cash inflow. Karnam Hari is also right. Karnam Hari is also right. And now we'll solve an equation. This is 3.791. Just put the value there. Then this number on the left side, this number on the right side. Write down. You can do it, but I am doing it for you. And then when you solve this equation, your answer will be 1 lakh. When you solve this equation, the answer will be 1 lakh. Okay, this 1 lakh will be required in my last answer, break even unit. Come to next point, calculation of annual sales unit. Calculation of annual sales unit. Calculation of annual sales unit. You are given PV ratio. Given PV ratio is 70%. What is your annual sales unit in the original estimate you have to find? PV ratio is 70%. Contribution to sales ratio 0.70 given. Therefore, variable cost to sales ratio 0.3. Variable cost is rupees 60. Variable cost is rupees 60. Therefore, selling price will be 60 divided by 0.3. Selling price is 60 divided by 0.3. 60 divided by 0.3 is rupees 200. 60 divided by 0.3 rupees 200. Therefore, contribution per unit. Therefore, contribution per unit. Therefore, contribution per unit is 200 into 0.7. 200 into 0.7. 200 into 0.7 is 140. Then write down annual cash flow given. Annual cash flow given is 57,500. 57,500. And how this annual cash flow is calculated? It is simply like one earlier problem also, quantity contribution, quantity into contribution minus annual fixed cost. Quantity into contribution minus annual fixed cost. Quantity is missing. Quantity is missing. Quantity is missing. Quantity is missing. Can you find out the quantity? Can you find out the quantity? Yes, answer fast. Contribution minus fixed cost is cash inflow. Contribution minus fixed cost is cash inflow. So please answer in quantity terms. 1,57,500 divided by 140. The answer is right. 1125. 1125. 1125 is right. And now my last easy answer. What is break even unit? Calculation of break even unit. Calculation of break even unit. Break even unit in the marginal costing chapter you have studied. Fixed cost divided by contribution per unit. Fixed cost divided by contribution per unit. Fixed cost divided by contribution per unit. 1 lakh divided by 140. 1 lakh divided by 140 is 714 units. Very good. 714, 715 you can write. Okay. This was my question number 43, a very important question we have covered. Please practice it every day. Very good, Mr. Hari, for giving correct answer. Now we'll go to question number 44, taken from study material. Unnat Limited is considering investing rupees 50 lakh in a new machine. The expected life of the machine is 5 years and 0 scrap value. It is estimated that 2 lakh unit will be produced and sold each year at a selling price of 30 rupees per unit. It is expected that variable cost will be 16.50 per unit. Fixed cost is 10 lakh per year. The cost of capital is 12%. So this is going to be my discount rate. Cost of capital is 12%. An acceptable level of risk is 20%. Acceptable level of risk is 20% means if the risk is more than 20%, the project will not be accepted. That I will require in the end. If the risk is more than 20%, project will not be accepted. You are required to measure the sensitivity of the project's NPV to a change in the following project variable. Selling price we can solve by solving one equation. Sales volume we can get it by solving the equation. Variable cost we can solve by solving one equation. Is it right? On further investigation, it is found that there is a significant chance that expected sale volume of 2 lakh units per year will not be achieved. The sales manager of Unnat Limited suggests that sales volume could depend on expected economic state, which could be assigned the following probabilities. Now suddenly they are changing the question. In the first question the sale quantity was 2 lakh. So all this calculation will be based on 2 lakh unit. But now they are thinking that no, sales quantity may not be 2 lakh, rather it can be 175, 2 lakh, 2,25,000 with these probabilities. Calculate expected NPV of the project. So again you have to compute expected NPV and give your decision whether company should accept the project or not. Calculate the expected NPV of the project and give your decision whether company should accept the project or not. So first we'll start with the original answer. In original answer we have all the variables available. Just arrange it properly and you will get the answer. We have sales quantity, we have selling price, we have variable cost, we have fixed cost. So step 1, write down little fast. Step 1, calculation of annual cash inflow. Calculation of annual cash inflow. Calculation of annual cash inflow. Under that write down sales, write down 60 lakh. Variable cost, write down 2 lakh into 16.50, 33 lakh. Variable cost 33 lakh. Fixed cost write down given 10 lakh. Fixed cost given 10 lakh. Therefore annual cash inflow will be how much? 60 minus 33 minus 10. Is it 17 lakh? Yes, cash inflow is 17 lakh. Now write down NPV. Step 2, NPV. Write properly. Somebody is checking your answer also. For NPV calculation, I will just write this simple format: year, particular, cash flow, PV factor at 12% and PV. Now do yourself. Please try yourself. Please try yourself. Cash flow 50 lakh cost of machine, annual cash inflow 17 lakh. Write the factors at 12%. Write the factors at 12%, that is 3.605. Write the factors at 12%. Multiply please. 6128,500. Check. 6128,500. Is the NPV 1128,500? Very good, Hari. 1128,500. Wonderful. 1128,500 is right. So this is my original answer. Okay. Now we have to do sensitivity analysis for three variables: selling price, sales volume, and variable cost. Next, write down sensitivity analysis with respect to selling price. Everybody should participate. Sensitivity analysis with respect to selling price. Let selling price per unit be S. Let selling price per unit be S, so that project will break even. With zero NPV. So that project will break even with zero NPV. Now I am going to write an equation. The PV of cash inflow should be 50 lakh. 50 lakh on the left side of the equation. Quantity sold 2 lakh. Selling price is missing. We will take it as S. Variable cost is 16.50. So this is contribution. Minus 10 lakh into PV annuity factor. 12%, 5 year. 12%, 5 year. 12%, 5 year. So please solve the equation. I'll wait for you. Solve this equation and find the value of S. Solve and find the value of S. Please reply fast. Please reply fast. I am waiting for you. Your answer should be S equal to whatever methodology you know, apply. Final answer must be right. Final answer must be right. Check the answer now. So I have started getting response from the student. You are right. 28.43 is the right answer. Very easy. Only with practice you can get in the exam very quickly. You don't not only have to get the answer, you have to get it fast also, because the paper is lengthy. With practice you will get it. 28.43. Therefore, sensitivity percentage is original estimated selling price 30 minus break even price, the price at which NPV is 0, 28.43. So this is my margin of safety divided by 30. Answer in percentage now. Answer in percentage now. Is it 5.23%? Please quickly. Yes, 5.23 is right. .23 is right. Now write down B, sensitivity analysis with respect to variable cost. I will do first. Variable cost. Sensitivity analysis with respect to variable cost. From the previous example, previous calculation, you can write, from the previous calculation, contribution required to have NPV equal to 0 will be selling price originally was 30. Selling price is 28.43 required and variable cost is 16.50. So you need a contribution of 5.23. 28.43 minus 16.50. Is it 11.93? 11.93. 11.93 is the contribution. Therefore, variable cost per unit required. Variable cost per unit required to break even with 0 NPV. With 0 NPV will be selling price is 30 rupees and I require 11.93. So my variable cost must be on a higher side 18.07. My variable cost on the higher side can be 18.07 and therefore sensitivity percentage will be 18.07 minus original estimate 16.50 divided by 16.50. So good student will reply, other student will watch the show. Is it 9.51%? Is it 9.51%? Yes, 9.51 is right. So whenever selling price and variable cost per unit is asked in questions like this, the variable cost part can be done faster. The variable cost part can be done faster. And now one more thing is pending. As far as sensitivity is concerned, write down point C, sensitivity analysis with respect to sales volume. Sensitivity analysis with respect to sales volume. I will have to solve one equation. I have to solve one equation. So please write down, let V be the sale volume. Let V be the sale volume so that the project would break even with 0 NPV. So that the project would break even with 0 NPV. So that project will break even with 0 NPV. Now write this equation. Now this time I will write, instead of sales volume, the quantity given in question, I will write V. You can take X, no problem, whatever suits you. Whatever suits you, you can do it. 50 lakh is equal to quantity assumed V into bracket 30 minus 16.50 minus 10 lakh multiplied by PV annuity factor. The number on the right side is PV of cash inflow. The number on the left side is cost of the project. If both are equal, NPV is 0. Please confirm what is the answer now. Students should work hard and solve the equation. Anybody for equation? Answer. You can solve in any manner you are comfortable. Is it right? You can solve in any manner you are comfortable and finally reach the answer. Finally reach the answer. Answer is very good. I got the answer, exactly same answer, 176,812. Very good. You are right. 176,812. Okay, this is my sensitivity analysis working. One last part of the question. Let us read the last part of the question again. On further investigation, it is found that there is a significant chance that the expected sales volume of 2 lakh units per year will not be achieved. The sales manager of Unnat Limited suggests that sales volume could depend on expected economic states, which could be assigned the following probabilities. So they are thinking that in future there are three possibilities. Sales can be, economic condition can be poor, and if it is poor, sales will be 1,70,000 and probability, write down nicely 0.30. If there is a typing mistake, rectify. Normal 2 lakh. For 2 lakh we have already done the calculation. For 2 lakh units we have already got the NPV some times back, which was positive NPV, and then it has a probability of 0.6 and it can be good. If it is good, 2,25,000 and the probability is 0.10. This probability column, if there is a typing mistake, please put it like this: 0.3, 0.6, 0.1. Question is, compute the expected NPV of the project. So for expected NPV, you have to find expected volume. So you are going to multiply these numbers by the respective quantities given. On the basis of the expected volume, compute the expected NPV. Next is, and give your decision whether company should accept the project or not. Give your decision whether the company should accept the project or not. So in some note above it was written, the acceptable level of risk is 20%. That means if there is a less than 20% chance that NPV will be negative, then we'll accept it. But if there is a more than 20% probability that NPV can be negative, we will not accept the project. So what we'll do, we will compute NPV in poor economic condition, normal and good. Normal we have already calculated. We'll also calculate the NPV when economic condition is good. If the NPV is negative, when probability is more than 0.2, then in that case we will say we will not accept the project. For that I need to compute NPV under different state of economy. Okay, so let us first answer. Oh, I have not written the sensitivity here. Please write sensitivity percentage. If not written, write sensitivity percentage. Please write down sensitivity percentage. Write down 2 lakh minus 176,812 divided by 2 lakh It comes to 11.59%. It comes to 11.59%. It comes to 11.59%. Now write down answer of the last part. Variable cost we have done. Variable cost we have done. Answer of part D write down. Answer of part D, last part. Answer of last part, expected NPV. Under expected NPV, first you need to find expected sales quantity. First you need to find expected sales quantity. First you need to find expected sales quantity. Write down expected sales quantity is equal to 1,75,000 into 0.3 plus 2 lakh into 0.6 plus 2 lakh into 0.6 plus 2,25,000 into 0.10. Is that equal to 1,95,000? Is that equal to 1,95,000? Based on 1,95,000, compute the expected NPV. Very good, Divya. Go ahead. Compute NPV. Quantity expected is 1,95,000 into contribution 13.50 minus fixed cost 10 lakh into PV factor 3.605. Solve. Minus 50 lakh initial investment. Minus 50 lakh is initial investment. Please reply little fast. What is the expected NPV with the given probability distribution? 885,163. Please confirm. Put your stamp. Is it right? Yes. Very good. But wait, the question says acceptable level of risk is 20%. Suppose we start the project and the state of economy turns out to be poor, whose probability is 0.3, then what will be my NPV? Let us calculate. Further NPV in worst and best case scenario. Suppose after we start the project, economy condition become poor, then I will get only 1,75,000 sales, whose probability is 0.3. So I need to check what would be NPV in worst case scenario. Worst case scenario means economic condition can be poor. So I will take now 1,75,000, that is the lowest sales quantity, into 13.50 minus 10 lakh, which is fixed cost, into 3.605, which is PV factor, minus initial investment 50 lakh. Please solve. If economic condition is poor, what would be the NPV? If economic condition is poor, what would be the NPV? The answer is negative 88,188. Very good. Negative 88,188. You are right. Then write down best case. Best case means quantity will be 2,25,000. 2 lakh we have already computed. We had a positive NPV. Now let us try 2,25,000 into 13.50 minus 10 lakh, that is fixed cost, into 3.605 PV factor minus initial cost 50 lakh. Please reply. Please reply. The answer is positive 23,45,188. Now my question is, which is a very intelligent question, will the project be accepted? when your acceptable level of risk is 20%. Now you see, there is a 30% chance of negative NPV, because if economic condition is poor, your NPV can be negative. Your risk tolerance is 20%. More than 20% chance of negative NPV, you will not accept the project. Project can have a negative NPV with 30% probability. Would you accept the project? The answer is no, because it is beyond our tolerance limit. So write down the conclusion of this answer. Thus there are 30% chance that there will be a negative NPV. There is a 30% chance that there will be negative NPV, and 70% chance of positive NPV, and 70% chance of positive NPV, and 70% chance of positive NPV. Since acceptable level of risk of Unnat Limited is 20%, since acceptable level of risk of Unnat Limited is 20%, and there are 30% chances of negative NPV, and there are 30% chances of negative NPV, and there are 30% chances of negative NPV, comma, project should not be accepted. Project should not be accepted. Project should not be accepted. Is it right? Project should not be accepted. So that was the answer of this amazing and wonderful question. Question 45 you will try as homework. Question 45 you will try as homework. No compulsion, only trial homework. If you can do it, well and good. Okay. So today we'll stop here. Thank you very much. And please ask your friends also to join us on the live stream YouTube channel. They will also be benefited. We are running a scheme right now for CA final new course student that you have to pay only for the books, and you will get the video lecture with 5-year validity free for FR and AFM. So take the maximum benefit of this opportunity. We have covered the entire syllabus in detail, and the lectures are currently getting recorded also. So you'll get the updated lecture, all study material, RTP, MTP, past exam questions have been arranged nicely concept wise at one place, and you will also get the summary chart and formula book also. Thank you very much, and I'll see you on Monday now. See you on Monday. Tomorrow will be holiday for you. Take care. Bye bye.